Hey everyone, Chris Versace here, Monday, January 13th. That means this is the week ahead. And yes, we do have a full plate of economic data on tap, at least half a dozen Fed speakers, and what we would call the real start to the December quarter earnings season. In other words, I think it's the first full week of trading that we've had in the month of January so far. And as we think about the start of the quarterly earnings season, if you're thinking it means, Chris, we're going to get a flurry of big banks reporting out of the gate, well, my friends, you are correct. And that fun begins on Wednesday. But let's set the table for this week by rewinding a little bit to last week. If you looked at the data as it kind of came out, we did see more signs that inflation accelerated in December. We can point to that via a couple different December PMI reports from ISM and S&P Global, but in my opinion, it was the noticeable jump in the prices component for ISM's December services PMI that really stood out. Why? Well, it hit the highest level in over a year. So not only was it, higher than expected, but it dramatically accelerated compared to November, telling us that at a minimum, inflation is sticky, but more likely accelerated during the month of December. Last week, we also had the December employment report, which I'm sure you saw the headlines. It came in hotter than expected. Significantly more jobs were created during the month than were expected, and a far brisker pace compared to October and November. Now, I would say that on the one hand, that is telling everyone, including the Fed, that wow, the economy is probably doing better than expected. We'll talk about the implications of what that means, but at the heart of it, please remember that we have more people working and more people earning and benefiting from real wage growth. That is a positive factor for the economy and for consumer spending. But when we step back and we take stronger than expected job growth, wages still growing around 3.9% on a year-over-year basis, and the December service PMI figures that I talked about, plus those other inflation indicators, man, oh man, the market was, as you probably saw on Friday, not in a good mood because we saw what we can only call the recalibration of the rate cut recalibration unfolding. Now let's remember too that back in December at the Fed's policy meeting when it delivered another 25 basis point rate cut, one that will probably now be viewed as not necessary. At the time, Fed Chair Powell's message was now the Fed can take a more measured approach to rate cuts. And that resulted in the number of expected rate cuts for this year, 2025, falling to one, maybe two, but the timetable also got pushed out a little bit. Now, after the data that we've seen last week, the market now expects possibly one rate cut in 2025, and it is pushed out way towards the end of the year, coming in the last few months. The windup of that recalibration saw Treasury yields climbing higher, the dollar strengthened, and as I already mentioned, stocks sold off. The bottom line here is that recalibration is not usually a easily digested event for the stock market. I will say that as we come into this week, and I'll be going over the things that we'll be paying close attention to, we will want to, keep our eyes on the S&P 500 in particular from a technical perspective. There is some support at the 100-day moving average, more support at the 200-day moving average, but that would mean some incremental declines in the S&P 500 to get there. So the catalyst for that, if it happens, could be in what we see in the data this week. So let's turn to that. Over the next couple of days, we are going to get another look at inflation courtesy of the December CPI and PPI figures. We will be focusing more on the core figures, but indications are that based on the PMI data, the wage data we've seen, we are going to see these inflation indicators come in a little warmer than expected. If it's just warmer than expected, that will probably reaffirm the move that we saw in treasuries, the push out in rate cuts measured by the CME FedWatch tool late last week. However, If this week's inflation data comes in hotter than expected, odds are we're going to see that loan rate cut for 2025 now expected by the market to get pushed out even further, potentially towards the very end of the year. It could even slip out of 2025 into 2026. So we'll have to see what the data says. Some other data we're getting this week will be the December retail sales report. And yes, this is going to be important for retailers. Why? Well, it captures the holiday shopping season. I would argue the best way to look at this will be to bookend November and December, so you get a real holistic view on the December shopping season, as well as, the holiday shopping season, as well as the early start to the returns that tend to happen right after Christmas. Now, also inside the December retail sales report, we do get trailing 3-month data, which means that not only for the headline figures, but for all the various line items that contained in the report, we will get a nice yardstick for the December quarter, and we can use that to measure companies' results as they start reporting in the coming weeks. So case in point, last week Costco reported their December comp sales. Holy cow, were they strong. Little question that Costco continues to win consumer wallet share. I think some folks were saying those numbers, man, in the US and on e-commerce in particular, they blew the doors off. I will also share that late last week we got the latest update on consumer inflation expectations, and they are rising. And I think this bodes extremely well for Costco. It tells us that they're likely to continue to take consumer wallet share as we kick off and move a little deeper into 2025. Now, as we tally the CPI, PPI data, the retail sales data, and some other data, I'm going to suggest that you keep a very close eye on the Atlanta Fed GDP Now's rolling forecast for the December quarter. Last week, before the December employment report, it was updated with a figure of 2.7% for the December quarter. The next update comes this Thursday, January 16th, which means it's going to include the December employment report and most of the data that we will get this week. Odds are it's going to be revised higher. Here's the deal. If it is, it means that the Fed can continue to take its time, slow walking to the next round of rate cuts, because inflation is high and the economy continues to perform very well. If we had saw those GDP expectations crater, that might have some start to think that the Fed could swoop in and bring the paddles out for the economy. But the reality is the economy, by a number of different metrics, is remaining, call it firm, call it solid, call it robust, all of those things. So the odds of the Fed having to come in and deliver any surprise rate cuts extremely low, in my opinion. But we do have about half a dozen Fed speakers on tap this week. And we are going to want to pay attention to what they have to say, because they'll be factoring into their thinking what we saw last week and the data that we'll get this week. My suspicion is that they are largely going to reiterate the message that Fed Chair Powell delivered back in December. But I would also say that we should be prepared for some less dovish comments, because coming into 2025, the Federal Open Market Committee, the FOMC, the policy deciders at the Fed, was reconstituted. And when you look at the lineup, it's fair to say that it skews a little more hawkish, certainly less dovish compared to what the committee was in 2024. Now, the message that I've kind of shared here is that rate cuts are essentially off the table for the near term. So the question becomes, folks, what is going to drive the stock market in the near term, the next several weeks? I think there are two things that we're going to have to pay attention to. First, quarterly earnings. I mentioned a few minutes ago that the December quarter earnings season will kick into a higher gear this week with the financials reporting. JP Morgan, Citi, Goldman Sachs, Bank of America, Morgan Stanley, and several others. They're going to give us a lot of comments on investment banking activity, IPOs, M&A, equity underwriting. We're going to want to see what they're seeing on the commercial banking side as well. What's loan activity? How's the consumer? But when we put it all together, we're really going to want to sit back and understand how they see the landscape unfolding in the months ahead, the quarters ahead. What do they see for the economy, the consumer, and the impact of rates being, without a question, higher for longer, or at least previously longer, or at least longer than previously thought. How is that likely to impact their business? How is that likely to impact overall economic activity? The bank's earnings and this outlook. It'll start to tell us if the consensus forecast for S&P 500 EPS growth this year of up 14.6% compared to 2024, it's going to tell us how realistic is that outlook. And if we want to get a little closer in, they will also do the same for how likely the March quarter EPS forecast of double-digit growth is for the S&P 500. So earnings growth is going to become increasingly important this week. I expect the market to focus in on it quite a bit. The second driver, as we move even further into the December quarter earnings season, is likely to be the unveiling of Trump's policies. Just consider the dates: January 20th, Inauguration Day, and that means that Trump will likely give an inauguration address, potentially laying the groundwork for what we're going to see on the policy front. That same week, we have the World Economic Forum in Davos. That's going to be held January 20th through the 24th, I believe. Notice the timing: inaugural address on the 20th, Davos the rest of the week. I suspect that we will be able to see a lot of comments, responses, reactions, call it what you will, from world leaders and business leaders to what Trump lays out in his inaugural address. And that's going to be something that we won't want to miss. There's a lot of questions, a lot of concerns about the potential use of tariffs, for example. Perhaps we might start to get some insight through the inaugural address. And of course, the response is something that we're going to want to take a look at. Perhaps this will start to remove some of the uncertainty about it. My suspicion is, however, that Trump is going to continue to use his art of the deal playbook, keep everybody off balance until we finally have formal policies put into place. But again, I think those two things will be of key importance to investors. Thank you for watching, and we'll be back with you next week with another look at the week ahead.